What if the charts you've been using to analyze market trends have been hiding more information than you think, and a candlestick chart actually shows a more nuanced picture of market activity? Many of us have seen those squiggly lines on financial news channels, but few really understand what they represent. A candlestick chart, with its unique shape, is often misunderstood as just a fancy way to show prices going up and down. But here's the surprising part. Each candlestick is packed with information about the market's behavior during a specific period. It's like a small story, telling us who's winning in the tug-of-war between buyers and sellers. The shape and color of the candlestick reveal the opening and closing prices, as well as the highs and lows, giving us clues about the market's mood. And here's the key part. By reading these candlesticks, you can gain insights into the underlying forces driving price movements, rather than just seeing the end result. So, let's break down what a candlestick chart actually shows and explore how it can help you better understand the markets. By the end of this, you'll have a clearer picture of how to decipher these charts and what they can reveal about market trends. If you're interested in learning more about how markets work, be sure to subscribe for more in-depth explanations. Vocabulary, volatility, liquidity, sentiment, trend, momentum. What does a candlestick chart actually show, and how do its various parts come together to give us a sense of the market's mood? A candlestick chart is made up of four main components: the open, high, low, and close, which are the foundation of understanding what these charts are telling us. Think of these components like the chapters in a story. Each one reveals a different aspect of the market's behavior over a specific period. The open is like the first page, setting the tone for what's to come, representing the price at which the market opened during that time frame. The high and low are like the plot twists, showing us the highest and lowest prices the market reached during that period, giving us a sense of the market's volatility. And the close is like the final chapter, wrapping up the story by showing us the price at which the market settled when the period ended. When combined, these components paint a picture of the market sentiment over a given period. And here's the surprising part. Each component reveals a different aspect of the market's behavior, from the overall direction to the level of uncertainty. By understanding how these components work together, we can start to decipher the language of candlestick charts. And that's where the real insight into the market begins. To fully grasp this, let's dive deeper into how these components interact and what they mean for our understanding of the market. Vocabulary, volatility, sentiment, components, behavior. What does the body of a candlestick actually represent, and why are those thin lines at the top and bottom, known as wicks or shadows, so important? The body of the candlestick is the thick part in the middle, and it shows the range between the open and close of a particular trading period. This could be a day, an hour, or even a minute, depending on the chart you're looking at. Think of it like a report card for that time frame, summarizing how prices move from the start to the finish. The color of the body, as we've discussed, indicates whether the closing price was higher or lower than the opening price. Now, the wicks or shadows are where things get really interesting. These are the lines that extend above and below the body, showing the highest and lowest prices reached during that period. Imagine these wicks as the high and low tides of a day at the beach, marking the extremes that prices touched before receding back to the closing level. And here's the part most people don't know. These wicks give us a glimpse into the market's volatility and the tug-of-war between buyers and sellers, providing valuable insight into the underlying forces driving price movements. By examining the body and wicks together, we can start to understand the dynamics at play in the market and make more informed decisions. Vocabulary, volatility, tug-of-war, report, extremes, forces. What does the color of a candlestick actually tell us about the market's direction? At first glance, it seems straightforward. Green for up, red for down. But here's the part most people don't know. It's not just about the color. The combination of color, body size, and wick length is what provides a more nuanced view of the market's momentum and potential reversals. Think of it like a traffic light. A green candlestick is like a green light, indicating the market is moving upward, but if the body is small and the wicks are long, it's like a caution sign. The market might be hesitant or nearing a turn. On the other hand, a red candlestick with a large body and short wicks is like a clear red light, signaling a strong downward trend. And then there are the times when the color doesn't match our expectations, like a green candlestick with a long upper wick, indicating buyers are getting exhausted, or a red candlestick with a long lower wick, suggesting sellers are losing steam. Understanding these combinations is key to deciphering the market's next move. By looking beyond just the color, we can gain a deeper insight into the market's dynamics and make more informed decisions. So, let's dive deeper into how these combinations work and what they can tell us about the market's potential future direction. Vocabulary: momentum, reversals, hesitation, exhaustion, dynamics. What if the shapes and patterns we see in candlestick charts are more than just random fluctuations, but are actually telling us something about the underlying market dynamics and the psychology of the traders driving these trends? Let's take a closer look at some of the most common candlestick patterns, such as the hammer, engulfing pattern, and doji. At first glance, these patterns seem to signal potential trend reversals or continuations. And here's the part most people don't know: they can be powerful indicators, but only if we understand the context and the underlying market forces that create them. Think of it like a conversation between buyers and sellers, where the hammer pattern, for example, can indicate that buyers are starting to gain control, pushing the price back up after a decline. And here's the surprising part: these patterns are not just about the shape of the candle, but about the story they tell about the market's participants and their emotions, such as fear, greed, and uncertainty. By understanding these patterns and the psychology behind them, we can gain a deeper insight into the market's dynamics and make more informed decisions. So, let's dive deeper into the world of candlestick patterns and explore what they can really tell us about the markets. Vocabulary: trends, reversals, dynamics, psychology. So, what does a candlestick chart actually show? It doesn't just display price movements. It reveals the story of the market's underlying struggle between bulls and bears. Each candlestick is like a chapter in this story, telling us who's winning, who's losing, and how the tide is turning. By deciphering this story, you gain a more profound understanding of the markets. You start to see the ebb and flow of sentiment, the battles for control, and the shifts in momentum. And here's the surprising part: this story is being written in real time, with each new candlestick adding a fresh paragraph to the narrative. As you learn to read this story, you'll begin to appreciate the intricate dance between buyers and sellers, and how it ultimately drives the price action. By grasping this fundamental concept, you'll be better equipped to navigate the markets and make more informed decisions. If you'll never look at a chart the same way again and want to dive deeper into the world of markets and trading, consider subscribing for more in-depth explanations and insights. Vocabulary: momentum, sentiment, narrative, momentum.